This crisis, it won't kick off with outright panic. No, it'll start much quieter, with assets that everyone thinks are rock-solid safe havens. Let me explain. Before the markets really unravel, it's the structured finance world that'll crack first. Right now, as we're speaking in late 2025, financing for AI data centers has absolutely exploded. Based on the latest industry reports from Reuters and Goldman Sachs, debt tied to AI and data center infrastructure has surged, from tens of billions in commitments in 2024 to projections of $150 billion just for U.S. leasing activity in 2025 alone. And that's before the massive capex ramps up further into 2026, with hyperscalers like the big tech firms on track to pour in up to $1 trillion by 2027. These aren't your standard corporate loans anymore. Developers are locking in long-term leases with tech giants, creating what look like steady, predictable cash flows. Then, those flows get pulled together, sliced up, structured into layers of risk, and turned into securitized debt instruments. Things like asset-backed securities ABS. Rating agencies have even rolled out specific criteria for these, treating them like utility bonds. Stable, infrastructure-grade investments. So who's buying? Pension funds, insurance companies, sovereign wealth funds, the folks hunting for reliable long-term yields in a low-rate world. In many cases, these get stamped with investment-grade ratings and pitched as low-risk plays. Sound familiar? Well, let's connect the dots here. This setup is structurally identical to the CDOs, collateralized debt obligations, that fueled the 2008 meltdown. Back then, it wasn't housing itself that blew up the system. It was how mortgages got repackaged into these safe products. Cash flows were tranched, risks were supposedly diversified, but transparency went out the window. Complexity masked the underlying fragility. Fast forward to today, AI data center-backed securities are playing the exact same role as those CDOs. As long as AI hype keeps demand forecasts sky high, refinancing stays easy, and capital remains dirt cheap, everything holds up. But if growth stutters or funding costs spike, the correlations spike too. Suddenly, these diversified assets all move in lockstep downward, and when big institutions start questioning the ratings, liquidity vanishes overnight. That's how safe assets turn toxic. And here's the thing, the warning signs are already flashing. Even as we head into 2026, the U.S. yield curve is still inverted, despite all those rate cuts we've seen. History tells us this never means a smooth recovery. It's more like a ticking clock for deeper stress. Long-term yields aren't budging downward. If anything, markets are whispering distrust. Meanwhile, credit spreads are creeping wider. Investment-grade ones are edging above post-pandemic averages, and high-yield spreads are baking in higher default risks. And these aren't after-the-fact signals. They show up early, before stocks take the real hit. Now fast forward to Q2 2026. Inflation rebounds harder than expected, even with all that easing from the Fed. That exposes the core flaw. Liquidity isn't the same as solvency. All those valuations propped up by cheap money, they compress fast. Equities tank, crypto follows suit, not as some independent hedge, but as another liquidity casualty. Credit markets freeze up. Remember, over $1 trillion in U.S. commercial real estate debt is set to mature by then, per S&P Global data. Banks get hammered from all sides. CRE refinancing headaches, exposure to these structured credits, and institutions pulling back en masse. Their response, they slam the brakes on lending across the board. By May and June, that's when the storm's core really hits. Everything correlates. Stocks, credit, real assets, alternatives. They all drop together. Supply chains don't break from shortages. They grind down from evaporating demand and locked up financing. It won't feel like chaos at first. It'll feel like the machine just quietly powering off. This is the core of the storm. And once this phase kicks in, there's no neat, controlled way out. Want to uncover more hidden financial truths like this? Hit like, subscribe, and drop a comment below. I'd love to hear your thoughts.